Assalamualaikum and hi, my name is Normarsha Adlina. Along with my team members from Debate 5A, are going to explain about the financial performance of Hup Seng Industries Berhad using a various financial ratio. Today, I'm going to explain about liquidity ratio. Liquidity ratios are financial metrics that assess a company's ability to meet its short-term obligation using its most liquid asset. These ratios are crucial for determining whether a company can pay off its current liabilities without needing to sell a long-term asset. They are important indicators for creditors and investors as they reflect the financial health of a company in terms of liquidity. Let's start with current ratio. Current ratio is a key financial metric that shows whether a company can pay off its short-term debts using all of its current assets. The formula for current ratio is straightforward. You simply divide the current assets by the current liabilities. For Hup Seng Industries Berhad in 2022, the current ratio was calculated as above. We get 2.05, means that in 2022, the company had 2 ringgit 5 cents in current assets for every 1 ringgit of current liabilities. In 2023, the current ratio increased to 2.27. This increase from 2.05 in 2022 to 2.27 in 2023 is a positive sign. It indicates that Hup Seng Industries Berhad was better at covering its short-term debts with its assets in 2023 compared to the previous year. This improvement suggests that the company's financial health is strengthening, which is a good sign for creditors and investors. Next, let's look at the quick ratio, which is a more stringent measure of liquidity. The quick ratio tells us whether a company can pay off its short-term debts using only its most liquid asset, excluding inventories. This is important because inventories might not be quickly converted into cash. The quick ratio is calculated by subtracting inventories and prepaid expense from current assets and then dividing by the current liabilities. For Hup Seng Industries Berhad in 2022, the quick ratio was 1.58. In 2023, the quick ratio increased to 1.82. The rise from 1.58 in 2022 to 1.82 in 2023 indicates that the company has become more capable of paying off its short-term debts with its most easily accessible asset. This is a positive development, showing a stronger financial stability without having to rely on selling inventory. It means that the company is in a better position to meet its obligations swiftly, which is reassuring for its stakeholders. Now we're going to explain about the factors affecting performance of Hup Seng Industries Berhad. The first one is market demands and sales volume. The impact is the level of demand for Hup Seng's product, both domestically and internationally, directly influence sales revenue. A higher sales volume can lead to better utilization of production capacity and improved profitability. Conversely, any decline in market demand can reduce revenue and negatively impact the company's liquidity and overall financial health. The second one is raw material cost. The impact is the cost of raw material such as flour, sugar, and palm oil significantly affects production costs. If raw material price rise, it can squeeze a profit margins unless the company can pass this cost on to consumer through the price increase. Hup Seng's ability to manage this cost effectively influence its profitability and consequently its liquidity ratio. The third one is operational efficiency. The impact is the efficiency of Hup Seng's production process, including utilization rate of its manufacturing facilities and the management of overhead costs directly affects the company's profitability. Higher operational efficiency can lead to cost saving and better financial performance, while inefficiency could erode margins and liquidity.
So hi, I am going to explain about debt ratio. So the term debt ratio refers to a financial ratio that measures the extent of a company leverage. The debt ratio is defined as the ratio of the total debt to total asset. Expressed as a decimal or percentage, it can be interpreted as the proportion of a company asset that are financed by debt. A ratio greater than 1 shows that a considerable amount of company assets are funded by debt, which means the company has more liabilities than assets. A higher ratio indicates that a company may be at a risk of the default of its loan if interest rates suddenly rise. A ratio below 1 means that a greater portion of company asset is funded by equity. As you can see over here, here are the formula for a debt ratio. So total liabilities divided by total asset. So here I already calculate the debt ratio for 2022 and also for the 2023. As you can see over here, for 2022 we get 33.7%, and for 2023 we get 32.3%. So that means the debt ratio measures the proportion of a company asset that are financed by debt. A lower debt ratio in 2023 compared to 2022 show that the company has reduced. It relies on debt to finance its asset. This could suggest improved financial stability and lower risk. So now move to the second formula is time interest earned. So for the time interest earned, earning before interest and taxes divided by interest expense. That means the time interest earned ratio is a financial metric that measures a company's ability to meet its interest obligation on its debt. It is also known as the interest coverage ratio. Essentially, the TI ratio indicates how many times a company can pay its interest expense with its earning before interest and taxes. So here is time interest earned for 2022 and also for 2023. So for 2022, we get 1,374.93, and for 2023, we get 3,259.99. So that means in 2022, the TI ratio was 1,374.93 times, while this figure indicates that the company was able to cover its interest expenses comfortably. It is on the lower side compared to 2023. In 2023, the TI ratio surged to 3,259.99 times, marking a substantial improvement from the previous year. The TI ratio measures how easily a company can meet its interest obligation. A significantly higher TI in 2023 shows that the company is in a much stronger position to cover its interest expenses with its earning, which is a positive sign of financial health.
Hi, my name is Nashamel binti Muhammad Shukri. My ID number is SIT230014. So right now, I want to explain question number 3, which is efficiency ratio. First of all, let us know the meaning of efficiency ratio first. Efficiency shows how well the company uses its resources to generate sales and profit. This ratio reveals how effectively a company manages its assets, inventory, and receivable. High efficiency ratio typically indicate good management and operational effectiveness, helping investors and analysts compare the company performance and make informed investment decisions. So right here, there are several methods to calculate efficiency ratio. First is inventory turnover. Inventory turnover is to calculate how many times business sold and replaced inventory per year. The formula is cost of goods sold divided by average or closing inventory. The second method is average collection period. Average collection period is to calculate how many days took company to collect debt from the client. The formula is to divide account receivable with credit sale, and the credit sale also need to divide by 316 days. And the last method is total asset turnover. This method to show how efficient the company use all assets in generating sales. So the formula for this method is to divide sales and total asset. So now let's calculate the efficiency ratio for Hup Seng Industry Berhad. So I calculate all of this method based on statement of financial position and comprehensive income given. First of all, for inventory turnover, the COGS for 2023 is 248,840,122 ringgit Malaysia, and closing inventory is RM 30,126,367. So I divide it, I got 8.26 times as the answer. For the 2022, the COGS for that year is 239,911,882, and closing inventory is 29,941,476 ringgit Malaysian. And after I divide all of this, I got 8.01 times. This means that the year 2023 have higher inventory turnover compared to year 2022. For average collection period, the year 2023 have 37,260,840 ringgit Malaysia for AR, and RM 357,217,867 for credit sale. First, we need to divide credit sale with 360 day, and AR we divide the answer that we got. So I got 37.5 day. For year 2022, account receivable have RM 40,168,825, and credit sale have RM 380,194,335. So we need to divide credit sale with 360 days first, and then account receivable we divide the answer that we got. So I got 45.4 days. So it means that the year 2023 takes short time than year 2022 to collect the debt. And the last method is total asset turnover. The sale for 2023 are 357,270,867, and total assets is RM 238,616,869. After I divide, I got 1.50 times. For year 2022 sales, I got RM 318,194,335, and total asset for 2022 I got RM 212,835,948. After I divide, I got 1.50 times 2. It means that 2023 and 2022 have same total asset turnover. For RM 1 ringgit asset, business generates sale for RM 1 ringgit 50 cents.
Hi, Assalamualaikum. My name is Amir Munkrim bin Muhammad Ali, and for this presentation, I will explain to you about profitability ratios. So, profitability ratio are a financial metrics used by analysts and investors to measure and evaluate the ability of a company to generate income relative to revenue, balance sheet assets, operating costs, and shareholder equity during a specific period of time. So, they show how well a company utilizes its asset to produce profit and value to shareholders. A higher ratio or value is commonly sought after by most companies, as this usually means that the business is performing well by generating revenues, profit and cash flow. So the ratio are most useful when they are analyzed in comparison to similar company or compared to a previous year. Now let's look at the first thing is net profit margin. For the formula, net profit margin will be need to divide net profit with net sales, and then we will time it with 100. For Hup Seng company 2023, the net profit margin is 12.62%, and for the 2022, the net profit margin is 8.20%. So the net profit margin increased from 8.20% in 2022 to 12.62% in 2023. This indicates improved profitability. This suggests that the company managed its expenses more efficiently in 2023 or achieved higher revenue without a corresponding increase in cost. Alright, now let's go to the return on asset, or we call it ROA. For the formula, ROA equal to net profit divided with total asset and will be timed with 100. So for the Hup Seng annual year, the calculation is 2023. In 2023, the ROA is 18.89%, And for the 2022, the ROA is 12.25%. This indicates that ROA increased from 12.25% in 2022 to 18.89% in 2023. This improvement suggests that Hup Seng Industry Berhad become more effective at converting its asset into profit in 2023. For the last part, will be talk about return on equity, or we call it ROE. So formula is ROE equal to net profit after tax divide with shareholder equity, and then will be timed with 100. So the calculation is for the 2023 we got 27.80%, and from the 2022 we got 18.48%. This also indicates that the ROE increased from 18.48% in 2022 to 27.80% in 2023. This suggests that the company generated a higher return on the shareholder investment in 2023, which is a positive indicator for investor to invest in the company. That's all from me. Thank you.